Ben, thank you very much for joining the podcast.
Thanks so much for having me. I'm looking forward to it.
Hey, Ben, so you've seen what's happening in the markets and you've seen all these kids jumping into Robinhood, treating investments like a game. So I thought it would be a perfect time to speak to someone who does stock picking for a living. And there would be no one better than you because I've seen you starting like years ago as a blogger and turning into a very successful money manager. So I thought I need to give a call to Ben.
Thanks for those nice comments. I'm working on the very successful part.
Here we go.
I see myself as having a long career ahead of me, but thank you for that.
So Ben, why don't you start with telling us a little bit about yourself and your career?
Yeah, thanks for the question. So, I didn't start off thinking I was going to be an investor. I came to it, in my early 20s, which I think it's a good thing because I was able to experience other kind of walks of life, other focuses, and figure out what exactly I wanted to do. So, from a career perspective, I went to the University of Pennsylvania. I was in the Wharton School. My family's in commercial real estate, and my path was really laid out in front of me. I thought that I was going to be the next New York real estate Zion, right? Like that was my thing. My family had owned and managed a number of properties, mostly in the Bronx actually for a number of years. We'd actually built a number of the properties, and so by the time I got into the business, we were in maintenance mode. My family, was very they my grandfather who really started the business was kind of grew up in the depression, and he was very risk averse. We had no leverage on any of our portfolio on any of our properties. He had an aversion to debt. He was very risk averse just in general. So in terms of either acquiring new properties or building new properties, there was just not a lot of movement. And I think real estate, it's interesting. It's become such a sexy asset class, right? Cap rates, which are basically the inverse of a multiple that people pay for real estate, are all-time lows, and some of that's due to interest rates, but some of it's due to the fact that it's become an institutional asset class. If you're a pension fund, if you're an endowment, if you if you are if you're an insurance company, you probably have a fair amount of real estate tucked away somewhere in your portfolio. The institutionalization of real estate has, in my view, raised prices to levels that don't necessarily justify or not don't necessarily compensate you for how complicated it is
Mm-hmm.
to manage a physical property. I mean, I feel lucky as a professional investor in stocks that, if I make a mistake, for the most part, I can just sell it. You don't get calls on a Sunday night because the roof collapsed. You don't get a call at 3 in the morning because there's a flood in one of your buildings. Like that doesn't happen with stocks. And so, I just think people underestimate and don't necessarily appreciate physical assets, especially that get beaten by the sun, rain, and snow and fire. You name it. Especially in New York City, crazy things happen. It was just I always equated to I was a firefighter, and it just wasn't engaging for me. I think what I fantasized about when I wanted to be a real estate investor was the kind of the value investing side, which is like finding undervalued properties, rebuilding them, maybe even finding vacant land that people had neglected and building that up. And so, but those things were just not happening. And it was in the midst of all of that that I had a good friend of mine who I went to college with, and we were living together. And he handed me a copy of Ben Graham's book, The Intelligent Investor. And that book literally changed my life. I read that book and I said to myself, this is what I want to do. I like the idea of the intellectual challenge of trying to beat a very difficult market. But and I always say this, that I was a value investor before I knew what a value investor was. And what that meant was that when I read Ben Graham's discussion of just very simply find undervalued assets and sell them when they get to fair value, that really resonated with me. And so I made the kind of crazy decision to leave the family business and try to get a job on the buy side. And I was successful in doing that. I didn't have a lot to offer other than a lot of passion, and a desire to be really good at this. And more than a decade into it, I still have that passion and desire. And I look at what I really love about investing, as a career, is that you're constantly learning, constantly reading, constantly learning. And I always say that you have as an investor, you have to know a little bit about everything, because as a generalist, someone who, we don't specialize in industrials or med devices or banks or something like that. We're generalists, and so I have to know a lot, or I have to have a very broad understanding of different kinds of companies and business models, and then I can dive deep and understand individual companies, kind of at a nuanced level. But I approach new businesses models and new companies all the time with very little backing aside from pattern recognition, a lot of time spent analyzing businesses, which gives you a framework that you can use. So I love that, and then again, I love the intellectual challenge of saying, all right, there's this semi-efficient market that most of the time works, but then at times, whether it's market wide or secure, based on a security specifically, the market swings between greed and fear, and those times when there's fear or when there's greed are opportunities for value investors to take advantage. And so it takes a lot of patience, it takes a lot of diligence, and it's takes a lot of the ability to mitigate your own behavioral biases, because because the market is going to give you a lot of information, and you have to distinguish the signal from the noise, and you have to identify your own biases, and all of that is fun for me.
And you mentioned the book by Benjamin Graham. So for listeners, who is Benjamin Graham?
So Benjamin Graham was the father of value investing. He was actually Warren Buffett's mentor. And so, Buffett worked with Ben Graham and for a number of years, and learned about, the idea of value investing from Ben Graham. And it's really interesting to think about the evolution of Buffett, from kind of a Ben Graham style investor to, what he did become, what he has become. I don't know what it means that he's buying an IPO of a company called Snowflake. I saw that today, and I'm scratching my head a little bit about what's going on at Berkshire, but never question the Oracle, because, somehow he over a long period of time, he's rarely been wrong. But Ben Graham was a balance sheet investor, which means that he was looking for stocks that were trading at a discount to their kind of what tangible book value or book value. And so he was investing more in asset heavy businesses where he could look at the business and the balance sheet and say, well, if you look at the cash in the building they have, and then their inventories, if you just liquidated the company, it would be worth a lot more than the current stock price. So that's a very different style of investing. That's more of a what is it worth in a liquidation as opposed to what is it worth as an ongoing business. And so what Buffett learned from Graham, I think, was the philosophy of looking for undervalued assets, looking for underappreciated assets, and then turn that into a framework that was slightly different. And I think Buffett's an investor in businesses as opposed to an investor in assets, which Graham was. Buffett's an investor in businesses, and he says, find me a business that's getting more valuable every day, that has the metaphorical or actual moat around it. The idea is that you have a business that's so good that that even if a poor person or a poor manager comes in, the business is so good it doesn't even matter, and the barriers to entry are so high that that you can keep out competition. And so if you think of some of the traditional great Buffett businesses that he's invested in over the years, you think of Coca-Cola, you think of American Express. These are great brands, with very, very strong moats, and that have compounded, which means they've gotten more valuable every day for a long period of time, and they've created a lot of wealth for him. And in Cove Street, getting to my firm a little bit, like we employ both kind of thinkings, like both the Buffett and Graham thinking, but for me, I spend most of my time thinking about these Buffett businesses that are getting more valuable every day.
Tell me a little bit about Cove Street. And you've been there for how many years now?
2011. I was just very briefly. So Cove Street is a long only investment manager, and as we were talking offline, a long only to be distinguished from a hedge fund in the sense that hedge funds have different fee structures. In specifically, they usually have a base fee of some kind, and then they have a performance fee on top of that. Almost all of our accounts are just based, kind of a flat fee based on assets. And then hedge funds have a lot of leeway to do things that we can't, and that we won't, because our clients don't ask us to. So that's shorting, buying options, going outside of public stocks, either buying public debt or, investing in oil and gas wells. Like, hedge funds can do a lot of different things that we don't. Like, we are laser focused on public stocks. So just wanted to put that out there in terms of distinguishing long only from the hedge fund world. And so we're located in Los Angeles. We focus on what I call small and SMID cap companies, and SMID is kind of what small is a term that means small and mid. So, kind of in our small cap strategy, we focus on companies that are $3 billion and under in market cap. And then in our SMID strategy, which I co-manage, we focus on businesses that are kind of in the $1 to $12 billion market cap range. And so we run concentrated portfolios. We believe deeply in concentration. So we don't think that there are hundreds of good ideas out there. We think that the markets are relatively efficient, and when you find undervalued securities, you need to be willing to swing large. And so we take relatively large position sizes. We run concentrated portfolios, and then we hold the stocks for years, with the goal of benefiting from the compounding that I was talking about before. I think what I love about us is that we're a quirky little firm. If you've been to, in a hedge fund or an old wealth management shop in New York, in a tall building, and some of them have wood paneled walls and everyone's wearing the same fleece. That's not us. Like, we're located in beautiful El Segundo, which is just south of the LAX, the airport. We are 10 minutes from the beach. We have graffiti on our wall. We wear shorts on Fridays. We all have lunch together. Every Monday we check in with each other to see what we did over the weekend. It's a very cohesive, close-knit, small firm. We're a boutique asset manager. We don't want to be Fidelity. Nothing against Fidelity. It's an incredible firm, but our clients are looking for differentiated thought, focus on smaller asset class sizes, and kind of having a quirky but diligent and employee-owned mentality, and firm, that I think you get with smaller firms that you don't necessarily get at a BlackRock. So it's been an interesting ride, I would say. So started in 2011 when the firm was founded. It's been a tough time for value investors. Growth, whatever benchmark you want to look at, growth stocks have absolutely demolished value. I don't think anything's changed about the logic of value investing or the philosophy, or changed about the way we should go about our process. It's just been a period where things that we like to invest in have not been in favor. And this happens. There are times that the value investors wander in the desert for years. And then you wake up in 2001, I think, where the NASDAQ was down big and value was actually up. The outperformance was just enormous. Because the tech bubble blew up, but they were cheap value stocks, and so value was up and the market was down, and so those are the kind of times you're waiting for. Still waiting for that, by the way. As 2020 has been a very bizarre year on that front, but we stick to our guns. Nothing about what Ben Graham said when he wrote The Intelligent Investor. Nothing about what Buffett wrote in his letters and his partnership letters back in, I guess it was the 60s. Nothing about what Seth Claremon wrote in The Margin of Safety. Nothing about that has changed, right? Like, the reason why there will always be room for people like myself in this world is because people swing between greed and fear, and emotions dominate markets.
So you mentioned a couple of things, and one of them is you're a concentrated investor. Like, how concentrated are you guys? How much is your biggest investment of the portfolio, and top 10, let's say?
Yeah, so we always say that our top 10 are going to be 50% or more of the portfolio. In the strategy that I co-manage, we have 3 position sizes: 2.5%, 5%, and 7.5%. In that strategy right now, I think we have 23 stocks. In our small cap portfolio, we have 2 position sizes: 2.5% and 5%. That's at purchase. And I think that strategy has, 31, 32 stocks right now. We also run a focus strategy, which is kind of a subset of our small cap strategy, which is 10 stocks or fewer. So, we believe in concentration, right? And the truth is, I think we would lean even more towards concentration, but to some degree, you really, really cut off the number of investors who are willing to consider you if you have 2 stocks. And even if that's the totally right strategy for both the firm and for the client, very few investors have the stomach for that. So our benchmark is a Russell 2500 value in the strategy that I co-manage. And so that has thousands of stocks and we have 23 stocks, right? We're going to look nothing like the index. So, could we be more concentrated? Absolutely. But are we also going to look nothing like the index that people are benchmarking us against? That's also 100% true. So, and sometimes that's really good. And sometimes that's really bad because, we're not going to move with the index. We're going to have very idiosyncratic returns. And, sometimes we look really silly and sometimes we look really smart. But it doesn't, nothing about that changes the process or the philosophy. And the concentration is core to that.
You mentioned that you have a few baskets like 5%, 2.5%. What happens when a company grows, let's say, to 10%? Do you have to rebalance it?
Yeah, so in our small cap strategy, we have a cap at 10%. So we would cut it down. I think that really hasn't happened. I mean, we've had stocks that have done really well, and I think we've always been, we understand what our clients are looking for, and we also understand, that we just have to be risk managers to some degree as well. So I think, would we let a stock, in the small cap plus strategy where we don't really have the limits in the same way, would we let a stock get to 15%? I think we would if it made enough sense. That would be a situation in which the business value and people lined up in a way that I'd never seen before. I mean, that would be an incredible opportunity. And not to say that it can't happen. The largest position we've ever had, at inception in a small cap plus strategy that I co-manage is 7.5, which is still a very large percentage of the portfolio, right? If you think of people who run hundreds or even thousands of stocks, right? Like in an ETF, it's not really comparable. So, I think you as an investor, you want the leeway to let positions run. You want the leeway to, structure the portfolio the way you see fit, but you also have to be cognizant of risk management and your client's desires and concerns. Because at the end of the day, you're investing money for pensioners and for, a university endowment, right? Like, your risk tolerance has to be somewhere on par with your client's risk tolerance. And that's, that's part of being in the long only world, right? Like, I think people have this, hedge funds are riskier and they can do weirder, more esoteric, more risky things. In the long only world, you're kind of in the box where, yeah, you can be concentrated and you can have, larger position sizes, but don't have a 30% position because that's not really what we're hiring you for. So, it's just a balance.
So let's talk about stocks now. And what I'm curious about is like, what's your investment process like? First, how do you generate the investment ideas, and how do you do due diligence? When do you decide to buy? When do you decide to sell?
Yeah, these are good questions. And so, since I work for Cove Street, I don't have my own investment process. We have a team investment process that we all follow. Everyone has a slightly different version of it, but I'll give you our 4 stages, and even if people have slightly different flavors of it, they all look pretty similar. So our first stage is idea generation, as you talked about, and we get ideas from all over the place. We run screens, which means that we have a financial software that screens. That produces screens that run every Saturday morning, that we go through over the weekend and we talk about on Monday morning. And so what it is we screen for good businesses trading at reasonable prices, then we screen for cheap businesses that are just things that are statistically cheap. I spend most of my time focusing on kind of what you call a GARP screen, growth at a reasonable price, or we have a screen that mimics Joel Greenblatt's strategy. He's a kind of high quality investor. Value investor. And so we have, those are the ones I pay more attention to. Again, I'm not looking for 50-cent dollars. I'm looking for 90-cent dollars that are getting more valuable every day. So we run screens. We also, we spend a lot of time when we could do this, we spent a lot of time traveling, visiting companies, going to conferences. We think that meeting people, and I'll get to the people side because that's a really important part of our investment process. But I think meeting people is really important to us, and so when we like to travel to meet companies, we like to go tour their factories. It makes it much more tangible because we're not trading pieces of paper. These are real businesses that are made up of people. And so when, a company's going to lay off 5,000 people, that's not just a statistic. I mean, these are people's lives, right? And we're owning shares of this business. And so is that, is firing 5,000 people, is that a good thing? I don't know. Maybe in the short term, it helps your margins, but is it a good thing culturally? And so like, these are the things that we're always thinking about. And then otherwise, we have a group of people who have been following the markets for decades. Our founder's been in the, running small cap money since early 90s. And so, we just have a lot of intellectual capital as a firm, companies that we've run across in the past, industries that we've followed. A lot of times we'll get an idea where we'll something will come up on a screen and we'll look at it and we'll say, this company I don't want to invest in, but look at this competitor. It looks like a way better business. And so, sometimes just knowing an industry well enough and looking at the competitive set can get ideas for you. So once we've generated an idea, our next stage is what's called the qualify stage. And so
Let me interrupt you for a second. I'm
Sure,
sorry.
go ahead.
You mentioned that you screen for companies, and by screen you mean you're searching for the companies that say for certain ratios, right?
Yes.
That's how
Sorry.
screen.
Yeah,
what ratios are those?
Yeah, so we have formulas. So we are one of our analysts used to be a computer scientist, and so he's programmed a bunch of formulas into our financial software, which is Capital IQ, by the way. It's nothing, this is not proprietary software. This is S&P. But what he does is he puts formulas in, and the screens run, and the formula looks for stocks that fit this criteria. And then a list of those populates, and we get an email with stocks that fit that criteria. And so we're looking at ratios, we're looking at price to free cash flow, we're looking at EV to EBITDA, but we're also looking for businesses that have high returns on invested capital and trade at some reasonable multiple. So we're always using. There's always a value component, right? Because if you just screen for good businesses, you're going to get a bunch of businesses that, as a value investor, you're never going to own. So there has to be some kind of value anchored to them. It's not, you don't have to just screen for the cheapest thing in the world. You can find ways to modify your formula so that you're looking for good businesses that are cheap.
And those formulas that you said that you had a formula, some type of software that you guys created, but people actually can do it themselves. It's going to be just a little bit more of a manual process, right?
Yeah. There are plenty of financial softwares out there. Capital IQ and Bloomberg are probably on the more expensive side for an individual investor. I believe Yahoo Finance has a screening tool. Yeah, if you're just looking for rudimentary metrics, valuation metrics, you can probably find free services. And look, there's nothing proprietary necessarily. We're not a Renaissance Capital. We're not a black box algorithm shop. Right? This is just the first step in our process, right? I would say the screening process, weeds out way more companies than kind of gets through the next step. So it's not that it's unimportant, but I would say the next three stages of our process are far, far more important than the screening. The screening is just an idea generation. And just like in any business, you have good ideas and you have bad ideas. It's what you do with them that really distinguishes you.
Got it. Okay. Sorry.
Our second stage, our second stage is the qualify stage, and this gets back to the concept that I was discussing with you, the Buffett and Graham idea. So what we're doing is we're doing the initial due diligence on this business to understand whether it's a Buffett or a Graham. And so just a quick refresher: a Buffett business is a business that's getting more valuable every day. It probably doesn't have a lot of debt. It's got some kind of, hopefully, a secular tailwind and growth. And it's probably not overtly cheap, but again, it's trading at like a 85 or 90 cent dollar. And then a Graham stock is a more cyclical business. It's a lower quality business, but it's really cheap. And so the reason why this is really important, and I'm getting to your question about buying and selling, is that understanding whether it's a Buffett or a Graham, and this is just step two, is kind of only the first stage of this, but understanding whether it's a Buffett or a Graham sets not only your buy discipline, but also your sell discipline. So understanding that you're investing in a good business, you're willing maybe to pay a slightly higher multiple or slightly something that's trading at a smaller discount to intrinsic value, and you're willing to accept that because the business is getting more valuable every day, and maybe there's not as much risk associated. And when we say risk, risk is nothing, means nothing more than losing money. That's what risk is.
Yep.
Permanent impairment of capital is what we're trying to avoid. And so with the Graham, there's probably more risk of permanent impairment of capital. So you require what's called a larger margin of safety. So that's, instead of buying an 85-cent dollar, you're buying you're buying a 50-cent dollar. And so that's your buy discipline. But the sell discipline thing, which I think is really important and people don't talk enough about, is also something that comes from this Buffett Graham paradigm. So when a Buffett gets to fair value, you're more likely to hold it because the business is getting more valuable every day. It's compounding. If it's got a good management team and secular tailwinds in the business, then you're okay holding it at fair value because it has the ability to compound and continue. And the stock has the potential to keep appreciating. But when a Graham stock gets to fair value, you're more likely to sell it because it's a lower quality business. Whether there's cyclical issues, whether there's an issue with its total addressable market, it just can't grow that much, or whether the management team isn't particularly adept, right? These are things that would suggest that you should be selling the stock near fair value because your margin of safety is gone. And so our second stage is really about determining that Buffett. We ask ourselves, is it a Buffett or a Graham? Because that's going to determine what price you're willing to pay for it and what price you would conceptually sell it at. And so this is really simply like just the first stage of reading the financial statements, reading the proxy statement, which is the filing that talks about compensation and the board structure, which is a really important document that in our process. In addition to starting the base of a model and understanding a little bit how it's valued, and from there, if you're interested in this idea, that moves into stage 3, which is our team tackle. So we have a little bit of a unique process.
I want to interrupt you for a second because I have a couple of follow-ups on that. So there are a couple of concepts that you mentioned, and I wanted you to elaborate a little bit. You mentioned 85 on the dollar, 30 on the dollar. Can you explain those concepts?
Yeah, sure. Sorry if I'm being a little too technical. So let me put it this way. So for a Buffett stock, you're willing to, so if intrinsic value is, if you were paying intrinsic value, it would be 100 cents on the dollar. You'd be paying $1 now for a dollar value. If you're doing that all the time, you're not buying things cheaply. You are kind of paying fair price and hoping that the appreciation of the business is relatively rapid. Your idea is to buy at an 85-cent dollar is just the idea of a 15% discount to intrinsic value, as opposed to 50-cent dollars. The idea is that the business is so, there's something about the business that's just subpar, and you require a larger margin of safety, which it means that you're looking to buy it at a 50% discount to intrinsic value. So that's all. That when I use those terms, I'm trying to frame for you how cheaply would you ideally want to buy the stock based on the quality of the business.
You also mentioned something as multiples. Do you mean multiples of what exactly?
So, determining intrinsic value is not necessarily, there's as much art as there is science in determining intrinsic value, right? There's not one number that this stock is worth X per share, and if you hit that number, a bell goes off, right? It's not that easy. You have to try what we call triangulate value. So we look at multiples of cash flow because we're cash flow oriented investors. So, what kind of free cash flow yield does the business trade at? We run discounted cash flow analyses in order to, kind of forecast the future and see what the company's worth based on our assumptions. We also run, multiples of EBITDA, which is another kind of cash flow proxy. Sometimes we'll use enterprise value to sales. So we use a number of different value techniques in addition to what's called the sum of the parts, where a multi-segment business each one of those businesses gets valued separately as if it was broken up in a sale. So what we try to do is triangulate value and understand with a lot of humility that you're never going to know exactly what this is worth. But what you want to find is a stock for which 3 or 4 of these different valuation metrics make it look like it's undervalued. And so if you embed conservative assumptions about the future and make sure that you are buying a stock that looks like it's trading at a discount to what you think is intrinsic value, we think that there's a lower chance that you're going to lose money. And that's our goal, is avoid losing money. And Warren Buffett has this quote that says, the first rule of investing is don't lose money. And the second rule is don't forget the first rule. And we totally believe in that. If you can avoid losing money in most of your stocks and everything else just does fine, you're probably going to do well as an investor. Don't have those large losses. Don't have, big drawdowns in your stocks. Don't make big mistakes. Make small mistakes that you can correct quickly.
You mentioned the two stages already. Let's go to the third stage.
So the third stage is what's called our team tackle. And so, as I mentioned earlier, we're all generalists, which means that we don't focus on specific sectors. And so that means we're all adept at looking at, kind of all different kinds of stocks. And so I could be looking at a consumer company, I could be looking at an industrial company, I could look at a medical device company. And if I'm excited about it, I'm going to raise my hand and say, hey guys, I think this is interesting. Let's do our team tackle. And our team tackle means that I'm going to recruit at least two of my teammates to help me on the idea. And so what we say is we have two longs, which are two people who are proponents of the idea, and then one short. And the short is the devil's advocate. The short's job is to look at the work of the two longs and say, this is an interesting idea, but I don't think we should own it for X and Y. I think that, I think that the longs are biased because of, this person's idea is to come up with reasons why we shouldn't, this person's role is to come up with reasons why we shouldn't own the stock. And the reason we do that is because as the lead analyst, let's say I'm excited about an idea, there's all kinds of behavioral biases that start to creep in. And I can start listing some of them, but one of them is the endowment bias, which is where, basically, if you've done the work on something and you start to feel an ownership of it, and then I think you're more likely to have a positive view of it and more likely to defend it, even if it doesn't make sense in the face of criticism. There's also called the sunk cost fallacy, where you've done all this work and something should come out of this because you've done all this work, so you should just buy it. Well, that's a fallacy, right? Like, you should, if it's not a good idea, it's not a good idea, irrespective of how much work you've done. The stock doesn't know how much work you've done on it. So these are the things that start to creep in as a lead analyst, because there's always this little tinge of excitement that you have. And so that short, that within the team tackle, that person's job is to kind of slow you down and say, hey, these are the things we should be thinking about. And so this is where we do the really deep diligence within our process. And this includes, kind of just everybody doing the normal blocking and tackling that we did in stage 2, but then it's accelerating it. And, that's when you could actually travel, that's when you go visit the company. That's when you go to industry trade shows. That's where you're scouring the internet for industry trade magazines and experts that you can talk to. That's where you're calling former employees. You're just doing a bunch of due diligence to start to get a really clear picture of what this company is. And so we have 3 pillars within our investment process. And I mentioned this earlier, but it's business, value, and people. And, all 3 of them are really important. It's not just the value. If you listen to CNBC, all you're going to hear people talking about is the business and what multiple it's trading at. But the people are also really important. And to do, I think sufficient due diligence on a company, you have to investigate the people. So that's, talking to former employees, that's going to Glassdoor.com and Indeed and looking how the CEO is rated. That's, scouring the proxy statement to see how people are compensated, because I think compensation tells you a lot about what companies value. And it also tells you a lot about what management's going to be incentivized to do in certain circumstances. So we do a lot, we do a lot of nuanced work on the business to understand the key drivers. And then we do a lot of work on the people. And then we, as I said, we triangulate the value. And I'll stop there if you have any questions about stage 3 before I move to stage 4.
No, pretty clear.
And then, so stage 4 is just our decision process. So it's our decision point. And that's when we, all the people who've gotten to get done work on the idea, get in a room together, or a Zoom room, as the case may be in this case, and make a decision. And so what's really, I think, great about our process is we record all our decisions. So we fill out what's called the decision process spreadsheet, which is just a checklist of all the things that we go through for all companies. Key variables, the short points, again, those points like why we shouldn't own the stock, and then some nuances about the business and the balance sheet and the management. And then we record the decision so that there's no what's called hindsight bias that kicks in. And so I think what you see in certain circumstances in any walk of life, if you look back on a decision that, you know, was made or wasn't made 2 years forward, you know, you're never going to remember who said what, especially in an investment world. So, you know, I think especially Jeff, our founder, saw at prior firms where, you know, someone would say, you know, a stock would go from 50 to 100, and the person would say, well, I said we should have bought that. And everyone else would be, no, you never said that. Well, that can't happen, right? We want to be consistent with our decision making. We want to be transparent with our decision making, and we record that on a spreadsheet, and we do that chronologically. And so at every decision point with this company, we all weigh in on what we think we should be doing. And so what that allows you to do is it allows you to go back and look at how you've made decisions, where you've been successful, where you've made mistakes, and you can tweak your process, or whether that's decision-making process or your diligence process, to try to mitigate mistakes and to try to surface more opportunities like the successful ones. And it makes us all put portfolio manager hats on, even for those of us who don't, you know, so my colleagues who, you know, don't run money every day. You know, the goal is to put your portfolio manager hat on. You're not just an analyst anymore. Should we own the stock? At what size? And if you don't want to own it right now, what price would you buy it at? Because that research process, those first 3 stages, they build intellectual capital, right? That's not wasted time. You take diligent notes, you talk to people, you build this firm understanding of this company. And so you don't want that to go to waste. So, you know, if you like this business and it's just not at the price you want to pay for it, then you say, hey, I want to buy it 20% lower, and you put it on a screen or a watch list. And then when it gets there, as a firm, you have the skill set and you have the intellectual capital to be able to move quickly if the opportunity makes sense.
So I want to do this mental exercise. Let's assume you're no longer with Cove Street. I mean, it sounds a little dramatic, but if you didn't work for Cove Street, how can you take that process and apply it to your investment process as a person? Like the same guys or girls who currently on the Robinhood, I want them to be able to watch this and adapt it to their day-to-day life. Meaning, they don't have a software, they probably don't have a chance to talk to management. So there are different ways around it, I guess. So let's go step by step and how you would go about the process.
Yeah, it's a great question. I think the first thing I would recommend for anybody who's trying to invest on their own is figure out what kind of investor you are. You know, are you a value investor? Are you a deep value investor? Are you a growth investor? I mean, and I know these are boxes that may not, you know, that may sound kind of arbitrary, but figure out your philosophical framework for investing. What kind of stocks do you feel comfortable investing in? What kind of businesses do you feel like you can analyze? Warren Buffett has this great idea of what's called a too hard bin. And that's the idea is that you have a bin on your desk where you throw the financial statements of companies that are just too complex, too difficult. You read them and you don't even know what the company does, or you're just, you don't know anything about biotech. And so you read a biotech 10K, which is with the annual report for a biotech company or any company, but you read the annual report for a biotech company and you don't know anything about phase 2 and phase 3 FDA trials, and you just throw in the too hard bin. So like figure out which you called your circle of competence, which is like companies, types of businesses that you feel comfortable investing in. I mean, I think first of all, figure out how much money you feel like you can wager's not the right word, right? You can invest in the market. It should be amount of money that you are not that you don't need for groceries or paying for college, right? This should be a money that is set away specifically to grow your wealth over time. So first start there, then think about like what kind of businesses that you feel like you can invest in. And then I think, and this I don't mean this to be self-serving at all. What we do is really difficult. And that's not, I'm not bragging about it. It's really hard to outperform the market. So if you're an investor who doesn't have the capability to do this full time, and you have the ability to buy an ETF, an exchange traded fund from Vanguard that has very low fees and will mimic the market's return, I mean, I think index funds are an incredible product for certain people, right? If you just want to invest for the long run, buy index funds, when and dollar cost average, which means when it goes down, buy a little more, buy a little more, buy a little more, buy on the way down, and I mean, I think that really works. So maybe even back up a step, like, should you be investing in individual stocks, or should you be investing in ETFs? Because the revolution in financial products that are cheap and accessible for individual investors has made exposure to global markets, not even just US markets, unbelievably accessible. So, I'm sorry I'm jumping around a little, but like, it's, you kind of have to figure out, is this for you? If you do feel like you have the desire, the time, and the skill set to research individual stocks, the first thing to recognize is that there's as much luck as there is skill in this. And so that's why it's so hard to beat the market, right? Because you can be really right on your idea and get unlucky, or you could be totally wrong and get really lucky. So, people can be successful in this, even if they're not doing the level of due diligence that we're doing. So it's this funny idea that, like, people who don't know anything about the market can be really successful, and people who know everything about the market can be terribly unsuccessful. So my advice is, read the financial statements. If you feel like you can understand the financial statements and that, like, they make sense to you, that's a really good start. Read the financial statements, read everything you can about the company, try to figure out a way to value it, and don't rely on anyone else to tell you how much it's worth. What else? Think about the people. Businesses are made up of people, and culture is really important, and integrity is really important, and the way you're treated as a shareholder is really important, and the way management treats you is really important. And so try to align yourself with people who seem to be friendly, and then feel, and more than anything else, feel, enjoy it, right? Investigating businesses is fun and interesting, but it's not a game, but it can be fun and interesting and intellectually challenging. And I think you don't have to feel like, just because you don't have all the financial tools, that you can't be successful. Mm-hmm. So much of being a good investor is being a contrarian. Find something that you think is misunderstood and invest in it, and as you gain new information about the security, change your perception and change your view of the probability of outcomes that are in front, that kind of are out there. But to be a good contrarian, you have to be willing to hold your position in the face of news that is not particularly good, because that's how you make a lot of money. Because that's that greed and fear thing that we talked about. When people are really fearful, there's always going to be a reason why you shouldn't own the stock, or why it can always go down more. And so I do think that, you're asking for advice. Like, I do think good investing comes with a contrarian streak.
It's a great summary, but I will drag you back to the a little bit technical side. So sure. Let's say the person is not trying to outperform the market, but is excited about stocks and wants to analyze it. So the first thing, I guess, he or she is doing, going, let's say, to Yahoo Finance and looking at the capitalization of the company, and which basically shows what the price of the company, let's say, right? Then what do they do next? Like, they pull the financial statements, let's say, from SEC Edgar, where I'll leave a link in the description. What do they do? What do they need to look at, let's say, in each statements?
Yeah, I mean, again, like, you're asking me to distill what we, takes months of research to do. But you start with SEC Edgar, which has a great platform. You put in the ticker of the company, and you immediately go, I think, what's called to the 10K, which I mentioned before, which is the annual report. It gives you a description of the business. It talks about the competitors. There's a lot of arcane financial and accounting stuff that you have to wade through. But probably the first 10 pages of the 10K are the most important, because it tells you what they do, how they make money, do they make money, who they compete with, what's their competitive advantage in theory, right? So that's that's where you learn about the business. The next step, I think, is you read what's called the DEF 14A, which is these are SEC filing numbers, and that, but it's what's called the proxy statement. And the proxy statement is what I mentioned before, is it tells you about compensation, how much the CEO made last year, what was he or she compensated based on, was it sales growth, was it earnings growth, was it some return on invested capital number, and also to gives you the structure of the board. The board of trustees is really important, right? Because these are the people who are making the decision about who's going to be the CEO. They make capital allocation decisions. Should they pay a dividend? Should they buy back stock? Should they buy another company, right? And so understanding the nuances of the board and the structure and who's on the board are really important. And then, Seeking Alpha, if you sign up for a free account there, I believe they have a lot of transcripts from conference calls. So read a couple conference calls. Every quarter, these companies report their quarterly numbers, and then most companies have quarterly conference calls where they'll talk about the business. They'll take questions from investors and analysts. So you learn a lot there. And so those are like the blocking and tackling steps because you're just, and that would be kind of like our stage 2, and just to get a sense of the business. And then, I guess you got to figure out a way to try to value it. And whether that's using historical multiples, you can go on Yahoo Finance and look at multiples that things are traded at. You can, if you're entrepreneurial enough, you can try to do it a simple discounted cash flow analysis. That's a little more complicated, and you have to have a view of the future, and you have to understand the economic drivers. But, like Warren Buffett doesn't do DCFs. Right. I don't know if this is a true story, but he basically, the idea is that he does this all in his head, which is possible. But, it's, again, so much of this, the technical side is important, but the psychological side and the contrarian side are just as important. Other resources that are out there, Google is a great resource, right? Like, put the company in a Google alert, and then every week look for news on the company. I do that for all of our companies. Look for trade magazines for the industry. If you're ambitious enough, I'll tell you a little secret. If you email the IR person and say, I'm an individual investor, this is the first stock I ever looked at, would you give me half an hour to ask questions about the company? If you're calling Amazon or Microsoft, they're probably not going to talk to you. But if you're calling a smaller company, I wouldn't be surprised if an investor relations person would be like, all right, I'll give you half an hour. I tell students to do that all the time. Call IR. They may talk to you, even if you don't own any shares. And even if you're an investor and you own 10 shares, right? It's possible. I'm not going to guarantee anything, but it's possible they'll talk to you. But there are resources out there for you. And I guess one thing, because, the world right now is, I think, swinging towards greed and away from fear. And so try not to, take a step back and try not to get caught up in the what's popular right now. Because if it's popular, that means people like it. And if people like it, it's more likely to be overpriced. And I think there are plenty of really high profile companies that you can think of right now that are probably on the cover of the Wall Street Journal in an article that would fit that category. Psychologically and process wise, you should be looking for things that are underappreciated because they're more likely to be undervalued. So I think I see a lot of younger investors and a lot of people who are just getting into the markets, getting excited about, the stocks that they hear about every day, whether that's Tesla or Amazon or Facebook or Google. Yeah. I'm not saying that any of those are poor investments. I'm not making judgments about them, but I just think that they're much less likely to be undervalued because there's so many other people focused on them and looking at them. And so if you can find a security that other people are not paying attention to for whatever reason, especially like if whatever the walk of life you're in, let's say you're not a professional investor, but let's say that you're, I don't know, maybe you're a technician at a healthcare facility. You probably know more about healthcare companies than I do. Right? Use whatever skill set you have. Let's say you work, in retail somewhere. You probably understand the nuances of a retail business that I can't possibly imagine. So, that again, it gets this idea of circle of competence. like as you're looking at your first stock, like in if you work in retail, I wouldn't suggest going to medical device companies. Use something that is, you go look at a company that is close to what you understand, because it'll be much easier that first time to analyze a company. You'll understand a lot of the key drivers just based on your own experiences. And then it's, if that's the case, and you think you have some kind of contrarian understanding of it that other people don't, that's how you can do well. But there are plenty of free resources out there. Just never forget that if you're investing real money, it's not a game. Like if you want to gamble, go to Vegas. Don't invest in the stock market, right? But don't, because like there's this, if you're investing in the stock market, there's this like there's this sense that you're investing as opposed to gambling. But if you're just picking stocks based on what you see in the Wall Street Journal, I think that's akin to gambling. And so you might as well just go to Vegas. If you want to learn how to analyze stocks, there are no shortcuts, right? It's like you have to do the work, and you have to be long-term. I think, as an individual investor, you should, if you're not going to buy an ETF, you should be somewhat concentrated, because how many stocks could you possibly know that well? It's a tough balance, right? Because then there's a lot of risk associated with that, but then there's also like how you're going to know 50 stocks well. So it's tough. Being an individual investor is tough, and that's why I think ETFs and other index-oriented product can be really good for at least a portion of people's portfolio.
Let me ask you the last question.
Sure.
What are the books and maybe blogs and some other resources would you recommend? You mentioned Benjamin Graham's Intelligent Investment in the beginning. You mentioned Seeking Alpha. I believe it has some stuff for people too. But what are some other books and free resources?
Yeah. So I think anything Ben Graham wrote, whether Securities Analysis, which is a more technical book, or The Intelligent Investor, I think they're absolutely just the Bibles of investing. There are plenty of other books on value investing that are great. Joel Greenblatt's book, you too can be a market genius, or whatever, the stock market genius, I think is a great book. There are plenty of books on the psychology of investing that I think you can read. There's a lot you can learn and self-teach yourself. If you want to learn about capital allocation, The Outsiders by Thorndike is a great book about great CEOs and great capital allocation. So there's plenty of books on there. You just go on Amazon and put in value investing, and you'll see. If you can get a copy of Seth Klarman's book, Margin of Safety, he hasn't released it in years, and so it trades for like $1,500 on Amazon. But if you can get a copy of that, it's an incredible book. Understanding, I look at reading about investing two ways, like understanding the mechanics of investing and understanding the psychology of investing. So I would say I spend as much of my time, learning about the psychology of investing and decision making and bias mitigation as I do the mechanics of investing. And then I would say, I don't, coming from the blogging world, I don't spend a lot of time there anymore, because I think the podcast world is just absolutely full of great resources. Like, I don't think you need to troll the internet to find great content. So, Masters in Business by Bloomberg is awesome. If you want to understand the psychology of investing, there's a podcast called Choiceology by Charles Schwab, with Katie Milkman, she's a PhD and a professor. It's really good. Capital Allocators with Ted Seides is great. Invest Like the Best with Patrick O'Shaughnessy is fantastic. There are incredible podcast resources that you can listen to successful and entrepreneurs and successful investors, and successful capital allocators, people who are like our clients. You can learn so much from podcasts, and so that's where I would go for free resources. Download Stitcher, download Spotify, and just binge on financial podcasts. You can go to our website, covestreetcapital.com, and you can see that I've been on a number of podcasts, and you can, kind of go down from there and see who else has been on those. But I think there's just a lot of content out there. A lot of it's free. You can learn a lot about the psychology of investing. You can learn a lot about the process of investing by listening to successful investors talk about it. So that's where I would go. Let me just step one step back and say, when I first got my job on the buy side in 2007, I didn't have any experience. Everything I had was self-taught. I had a background in business from being at Wharton, but that was like, years ago, and I hadn't really paid enough attention in my accounting classes to really be dangerous. And so all I really had was a passion and a willingness to teach myself. And so how did I teach myself to be competent enough to get my first job? Was by reading those books. And I didn't have podcasts, right? So I was reading blogs, but I was reading a list of books the kind of the value investing Bible, and the other the encyclopedias of value investing kind of books that are out there. And I taught myself. And yes, was my analysis of companies incredibly rudimentary? Absolutely. But again, it's like, there aren't a whole lot of shortcuts other than just doing it. And maybe, and there's no substitute for investing, real money. So even if it's $100, right? Maybe you have a paper account where you're just, making decisions, right? Like, you got to start somewhere. You don't, not everyone starts with $5 million to start, their investing career. So, read the books, take advantage of many free resources. If you're really serious about it, start with a small amount of money and start like just getting a feel for what it's like to manage a portfolio. There's plenty of resources out there, but always keep in mind that it's not a game, and you can lose real money. And if you're following the crowd, it may be really fun for the short run, but in the long run, the tide's going to go out and it's going to go the other way. And as Buffett said, that's when you find out who's been swimming naked. And that's when you don't want to be that person swimming naked and who's lost money.
Well, Ben, thank you very much for being on the podcast. It was a great summary, and it's a great investment advices. Appreciate it.